Welcome back. Today, we're cracking open a topic that is honestly the absolute bedrock of modern financial transparency. In this explainer, our goal is decoding the SASB standards specifically for investment banking and brokerage. But we aren't just looking at the flashy sustainability headlines today. We're zeroing in on activity metrics. We are going to reveal exactly how the standard requires massive financial institutions to truly measure and report the actual scale of their operations. Get ready, because understanding this is going to completely change how you read every financial report from here on out.
Okay, let's dive into this roadmap. We'll start with the need to normalize, then break down metric A for capital raising, metric B for proprietary investments, and metric C for market making, before finally wrapping up by comparing apples to apples.
All right, Section 1, the need to normalize.
So before we can accurately measure anything, we really have to understand the central problem we're trying to solve, which is basically making sense of massive, completely disparate sustainability data points across the whole global financial sector. I want you to think about this for a second. How do you genuinely compare the sustainability metrics of a trillion-dollar global megabank to a regional boutique broker? Like if I tell you a bank paid $10 million in legal fines or that they generated $50 million in ESG integrated revenues, what does that actually mean? Without context, raw numbers are essentially useless. $10 million is a catastrophic lights-out fine for a small boutique firm, but it's literally a rounding error for a global titan. We need a baseline.
Well, SASB provides a pretty brilliant solution with what they call activity metrics. Technically speaking, these are quantitative measures of the scale of specific activities or operations by an entity, and crucially, they're intended for use in conjunction with sustainability metrics to normalize data and facilitate comparison. Really, you can just think of activity metrics as the vital denominator in our math equation. They give us the scale of operations so we can actually make true, fair, apples-to-apples comparisons across the entire industry.
Moving right along to Section 2, Metric A, capital raising.
And this brilliantly illustrates exactly what we're talking about. This brings us to the services investment banks provide directly to their clients. SASB lays out 3 core activity metrics for this industry. So let's break them down, starting right at the top.
Just to ground us, SASB uses a very specific alphanumeric code to keep all this standardized. FN stands for the financial sector, IB is for investment banking, and this specific activity metric is 000.A. You'll see this everywhere. It's the universal tag used globally for reporting on client-facing capital-raising activities.
Now, for this metric, SASB demands a very specific rhythm to the data. They definitely don't want a vague summary here. They require 2 precise data points, the exact number and the total value. And they require that for 3 distinct types of fee-based client transactions: underwriting, advisory, and securitization. Basically, you have to tell the world exactly how many deals you did and the total financial weight of the whole lot.
Just to make sure everyone is measuring the exact same thing, the standard provides super strict definitions. Underwriting, for instance, is defined as raising investment capital from investors on behalf of entities, like corporations or governments, issuing either equity or debt securities. It explicitly covers both public offerings and private placements, so whether a bank is helping a hot new tech startup go public or helping a government issue bonds, it absolutely counts right here.
Now, what's really interesting about this is how it clarifies some of the heavier banking jargon, like securitization. The standard defines this as creating a financial instrument by combining other financial assets, think residential mortgages or corporate loans, and then marketing various tiers of those repackaged instruments right back to investors. This ensures that those massive, incredibly complex operations that repackage debt are actually counted in the bank's overall scale of activity. No hiding in the complexity.
Okay, Section 3, Metric B, proprietary investments.
So we're shifting our focus now from what the bank does for its clients to what the bank does with its own money, its own skin in the game, so to speak. The official SASB metric code here is FN-IB000.B. This captures the entity's proprietary investing and relationship lending activities across multiple asset classes, like debt securities, equity, infrastructure, all of it.
And check this out. Notice that rhythmic repetition from the standard popping up again? Just like with capital raising, the bank has to report both the exact number and the total value of these proprietary investments and loans. But there is a totally crucial addition here. They must classify all of these by sector.
To prevent banks from basically just making up their own vague industry categories to sound good, the standard mandates the use of GICS, the Global Industry Classification Standard. Specifically, they need the 6-digit industry-level code for classifying investees and borrowers. Which is brilliant, right? It guarantees totally standardized reporting. If we want to know a bank's exact scale of financial exposure to the energy sector versus the healthcare sector, GICS ensures we are looking at perfect standardized data.
All right, Section 4, Metric C, Market Making.
This takes us directly into the high-energy, fast-paced environment of the trading floor. The final activity metric code is FN-IB-000.C. Market making is, of course, fundamental to investment banking. It's how these institutions provide liquidity to the global financial markets by constantly buying and selling securities. This metric is designed to measure the sheer, raw volume and scale of those trades.
Let's see how this builds out. To get a complete picture of a bank's trading footprint, SASB absolutely does not let a bank lump all its trading into one bucket. It forces them to break transactions down into 5 specific asset class slices: fixed income, equity, currency, derivatives, and commodity products.
And, well, you can probably guess the pattern by now. Across every single one of those 5 asset classes, the bank must report both the total number of transactions and the total value of those transactions. Quantifying this across fixed income, equity, currency, derivatives, and commodities is how we truly accurately measure the trading scale of any financial institution.
Which brings us to Section 5, Comparing Apples to Apples. So it's time to bring all 3 of these metrics together and finally see the big picture. The absolute crucial point comes down to this setup. Think of an entity's raw sustainability data, like a massive fine from a legal proceeding or totally stellar revenue from ESG integrated transactions, as your numerator. But that numerator only tells a meaningful story when you divide it by your denominator. And that denominator is the activity metrics we just learned about, the total number and value of their capital raising, proprietary investments, and market making. That is how you find out if a bank is actually improving its practices or if it's literally just getting bigger.
Which leaves us with this final thought. Now that you actually know the hidden machinery here, the exact SASB metrics used to measure the true scale of an investment bank's operations, how is that going to change the way you read their next sustainability report? Are you going to settle for the flashy raw numbers they put in the headlines, or are you going to look deeper, seeking out the vital context of scale to find the real story? Thanks for joining me on this explainer. It's been fun. Until next time, keep looking for the denominator.